What's going on, everyone? Lilith here. Today we'll be talking about 5 mistakes to avoid regarding covered calls. There are timestamps below, so feel free to forward accordingly. And if you're watching this video, you probably know what covered calls are, but just in case you're researching and understanding if it's something for you, I'll be talking about that as well. So we're starting off with that and then getting into the mistakes. So again, fast forward as you need. But with that, 2 things: smash, subscribe, you know how it is. And with that, we'll get straight into it. Covered calls. There's other videos on the channel, but overall, covered calls is an option strategy where basically within options you have calls and you have puts. On the call side, you have types of calls. For example, naked calls, you have covered calls, you have other types of option strategies, and within calls and within options in general, you can buy them and you can sell them. For the purpose of this video, within options, there are calls and puts, but I'll be sticking to specifically calls and within that covered calls. When we talk about calls, we're talking about a type of option contract. And basically, a call contract gives you the option to buy a stock at a particular price in the future. For example, let's say there's stock A and it's at $100 and you think that, hey, within a month, this $100, it's going to go to $150. Just an example. And so what you may do is, let's say that you want to buy a call contract in order to purchase this stock at $120 1 month from now. If you buy this call contract, then somebody's willing to give you their shares at $120 a month from now, and you're thinking that, hey, it's going to be $150, so off the bat, you're going to be in profit. The question is, if everyone thinks that it's going to go to $150, then why would someone actually sell you their shares at $120 a month from now? And so that's where coming into buying versus selling is important to understand the difference. When you're buying or selling option contracts, there's something involved known as premium. And so when you want to buy those shares at $120, there's something that you're going to pay as premium to the person selling the option. And so let's say that, hey, it's going to go to $150 in our example, and you buy it at $120. Just an example, maybe you're going to be willing to pay $5 in premium for every single share you get. This $5, in addition to the $120 you're going to pay, is going to basically make your average cost of shares to $125, which still leaves you with $25 difference in your strategy and thinking for those shares to be at $150 minus the $125 you're paying, so you're still up $25 a share. Naturally, this is if everything works out, but the point here being that $5 you're spending if you're buying a contract. But on the other side, someone's willing to sell their shares, aka they're selling a call against their own shares that they have. Today we'll be talking about selling covered calls, aka you're the one receiving that $5 in premium as income or as real hard cash in general. And that cash, you can consider it as potentially income to buy more stocks, income to maybe invest some more into different stocks, take that money and go invest it into other type of asset classes. But in general, you're able to actually get real cold hard cash to be able to do anything. Nothing really comes for free, as the stock market is indeed a zero-sum game. So at the same time, there's some losing elements and some gaining elements. But the point here is to really understand some of the mistakes that one can do by chasing maybe potential premium through covered calls, or just using covered calls as a strategy as a whole. I've been trading covered calls for some time and options in general, and being involved in the stock market as well, and different asset classes. But the point here is that I've made all the mistakes that we're about to go into, and just want to put this out here to hopefully fast track you, and also to hopefully not allow you to make the same mistakes by sharing my experience and otherwise. And with that, we'll get straight into it. Starting us off, let's look at Square Stock to walk us through this example. So looking at the 3-month graph, you have this 276 around this high 270 regions, and in general this is the all-time high price for Square as well. And there's no actual issue buying at an all-time high or dollar cost averaging or whichever your strategy may be. But the mistake, quote unquote, is essentially buying at such a price, and if you expect a correction to happen, whichever magnitude of correction, but basically having the confidence or overconfidence of buying a stock at any price just because you'll be able to collect premium to ride it down. And so looking at Square stock specifically, if you had bought, let's say, just for an example, at this 270s price region, you have this correction all the way down to 201.87. And if you're trading that day intraday, I remember the price going down to 192. And so look at this, with 70 to 80 points difference, which is almost 30% in Square stock in terms of price difference, when you compare that difference to the actual options trading prices, even if you look a month out to gather some premium, if you look at the 230 calls, 12.98, it's roughly 5% in premium. And so that won't make up for the whole 30% difference. Again, that whole 30% difference is short term, and naturally you'll be getting compensated that 5%. But when you take a different example, for example, when you look that many points away, if you've wrote it down and now your average cost is, let's say in that 270s, we're talking about 70 points. And as we know, options math in general does not work like this, but at a high level, if you look 70 points above 230, you're looking at $300. And so $1.07 versus all the way down here of $12.98. So your difference in premium is quite substantial. And at the same time, to get $1 each and every, in this case, a month, just to ride that back up is not really realistic. Again, there's fluctuations, but the mistake is having that confidence and overconfidence of being able to write it down, whether that's a short term or the long term or in general, just because you're getting premium from covered calls. Moving on, we got ticker symbol ABBV, aka AbbVie stock. AbbVie is super famous in the DGI community, aka dividend growth investing. And what I want to point out over here is basically by looking at the options chain, something super important. So it's trading at 103 over here. It closed at 103.79 today. And if you go to trade options, let's take an example of looking at a month out again. So around over here, April 16th, just an example. But if you go to the 120 calls, it's more points than normal and price fluctuations don't happen with AbbVie stock. But if you look at this limit price, you have a bid of 8 cents and an ask of 14 cents. And so looking at that bid-ask spread, what happens is, on average, it says 11 cents as that mid price. And so the quote-unquote mistake here is basically just not really looking at the limit prices, but just looking at that mid price or what price is shown up on your brokerage or exchange in general of what you need to do. When we consider one contract, that spread is 6 cents, aka $6. But if you're talking about, especially if it's in your dividend growth investing portfolio, and let's just say you have contracts against, for example, 1,000 shares, 10,000 shares, now we're talking 10 contracts, 100 contracts. And depending on how you use these premiums, whether it's reinvestment or income or other reasons, overall, we're looking at substantial difference. For context, if you look at that 3-cent difference, and if you consider 8 cents as your bid and 14 cents as the ask, you're looking at 3 divided by 8, which is a difference of 37.5%. And when you multiply those numbers and scale it up, that could be that substantial difference. We'll be taking specific stock examples moving forward, but for this next mistake specifically, it's applicable to all stocks. So this mistake is basically selling at market open. There's nothing wrong at selling at market open fundamentally. You will get that premium. But just seeing from my own experience and my own mistakes made, basically if you sell at 930, 931, 932, that full volume hasn't hit. And so when you actually look at the first 10 minutes of the market, the first 15 minutes of the market where you have that huge volume, and the last 15 minutes of the market, etc., basically there's so much volatility and volume on average that basically it makes sense to just wait a little so that you can actually get more of that volatility, aka implied volatility, pushing up those premiums depending on which direction you're trying to target at. If you have Robinhood, you're probably aware that basically execution speeds are not the most optimal for Robinhood versus the bigger brokerages. And so when you talk about the actual execution speed, you're also getting into that area of getting that best favorable price. And with best favorable price, we're talking about premium that you're collecting. Depending on how your investing strategy is set up, and I talk about my investing strategy in 2021, and again, this isn't financial advice, but overall, you could probably consider, hey, you want to leave a separate account just for selling covered calls, so maybe that you can track better, but more importantly, let's say use Robinhood day-to-day or Webull day-to-day, etc. Maybe you want that bigger brokerage just to be doing this type of options activity. Next, we'll be looking at the stock SPACE for this example, and I call it SPACE, but it's ticker symbol SPCE, aka Virgin Galactic Holdings. So if you go to trade options, let's take the week of April 1st for this example. And I'm going to use some extreme numbers over here just to bring this point home. So sitting at 31.90 at close, let's say 32 call, $2.49. Now, let's say you're super bullish on SPACE for the long term and you don't want your shares taken away. Naturally, covered calls and planning and getting into this position in the first place is something to consider, but we'll just be taking this example. So $32 call, $2.49. Let's say there's a few points move. And for the extreme example, let's just say that it moves in such a way that your premium is double. So aka whatever premium you received, let's say $2.49, you're going to have to spend that same $2.49 times 2 to buy the close. And that's kind of seen around, let's say at the $28 call, you have $4.83 in premium. So basically you've actually negated the premium you received and you've actually spent $250, so you're down $250. Now, if you go to the week of April 9th, where I want to bring this point home is your net negative $250 in terms of premium collection, and we'll leave the stock price and in terms of principal amount out of consideration. But let's say that you're super bullish and you're also thinking that in the short term it's going to go way up. So let's just say that for an extreme example, let's say you're thinking it's going to go to $40. So $40 call, it's 90 cents or 93 cents rather for premium. So you're down 250 and you've received 93. And where this mistake, quote unquote, happens is basically that, let's say you got 100 this week, so you've recouped 100 of the 250 you spent in that week of April 1st. And let's just say for an example, the next week, let's say you accrue 100, but let's say you got 100 and then you need to do something to buy to close again. And let's just say basically you're not keeping track. The mistake here is if you're not keeping track of how much you're actually spending in excess to buy to close, then basically you can keep collecting premium. But if you keep buying to close and you're net spending money, then in the end, you may not actually be benefiting and in the end profiting from doing this whole option strategy. Transitioning from there, we're going to look at ticker symbol UVXY next. It's an ETF and it tracks the volatility index, aka the fear index, and it can be supremely volatile where there's a lot of IV, aka implied volatility, and with that, let's look into UVXY. So trade options. Let's look at April 1st. So April 1st, it's at 708, basically close price. Let's look at the $7.50 option contract. So we press it and look at the limit price, 60 to 62. Not a big spread, not bad compared to that AbbVie example. But basically when you press this, down over here in Robinhood specifically, you can look at the actual IV and it's 138.15%. That's pretty dang high, especially when you compare it to other stocks like your AbbVies or Coca-Colas or other DGI or less volatile stocks. And so the point over here is there's a lot of IV, and so there's a lot of potential to make money when you're trading these options. At the same time, when you're selling calls and you're getting some type of premium, if we look at the actual contract or rather the option price itself, if you look at that 750 call, 61 cents. So it's almost 8, 9, 10%. 10% would be 75 cents, so you're looking at almost 8% in terms of the premium you'd be collecting. But looking at the volatility, if you look back at UVXY and just the way this ETF works, how it's actually 1.5 leverage, there's some details to UVXY which I won't get into in this video, but it's really important to understand the stocks you are trading those options with. And so when you look at the 1 month, it's down 21%. And so you can get that huge kind of 8% premium within a week, for example. But when you compare it to this type of graph and you look at the 3 months, it's down 34.51, 1 year, almost 100%. It's a decaying ETF in general in terms of the price action. So it's really important to also understand what you're trading, not just looking at that premium, looking at implied volatility, and looking to make a quick buck. I planned this video around 5 mistakes I wanted to cover, but here's a 6th and bonus one because I really think it's important to just put it out here for those special consideration and special items. So looking at ticker symbol RKT, aka Rocket Companies. So when you go to trade and trade options, if you look at any week in general, and there's a reason for this until a certain point, and I'll get into it. If you know what I'm talking about with Rocket, you'll know why, and if not, then I'll explain. So if you look at the strike prices, it's 23.39, 23.89, 24.39, 24.89, and it is still in that 50-cent kind of interval, but it doesn't look like that normal 50-cent interval or dollar interval or $5 interval, etc. And the reason for this is, in the recent earnings report for Rocket, they released a special dividend to be payable on March 23rd of $1.11. And so if you look at the math, 23.39, you do the math, you're looking at $25, or 23.89, you do that math, you're looking at 25.50, etc. And so it's payable on March 23rd, and even though the weeks are March 26th here, April 1st, April 9th, basically the dividend hasn't been paid out yet, but it's accounted for. And so after March 23rd, I do suspect that these strike prices will naturally just convert back into those 50-cent, $1 intervals. But I just wanted to put this out there because if you ever see some weird strike prices, there's probably another reason. And in this case, this is the reason for Rocket Companies. So with that, thanks for coming to the end. Peace.